Hello, this is Connie Belden, and in this video we were going to look at the variable and absorption income statements. Assume you're given the following information. Let's assume we produce a flute instrument that sells for $625. There's no beginning inventory. We produced or made 225 flutes, and we sold 200 of those flutes. That leaves us with 25 flutes in our ending inventory when we take 225 produced minus the 200 that we sold. For cost, we have variable cost of materials, labor, variable overhead, and variable S&A. Those are all per unit. We have fixed manufacturing overhead, that is in total, and fixed selling and administrative, that is in total. So let's assume that the absorption income statement has been prepared for you. You're given that sales are $125,000. And by the way, that breaks down to the selling of 200 flutes like we show above. Because if you take the $125,000 and divide it by the selling price of $625 per flute, that gives you 200 flutes sold like you see here above. We'll take out cost of goods sold of $49,000. We'll discuss how we came up with that in a moment, to leave us with $76,000 gross margin. Selling and administrative, that's variable and fixed together, is $12,000. Subtract that out using the absorption costing income statement. Your net operating income is $64,000. Now, step one, let's compute the cost per unit, cost per flute, using the absorption method. That will use three items: direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. And we do need to get that per unit. Okay, let's start with direct materials. That is given to you at $50 per flute. Direct labor is given to you at $160 per flute. And variable manufacturing overhead is given to you at $20 per flute. Now, for fixed manufacturing overhead, it's given that the total fixed manufacturing overhead for all flutes produced is $3,375. Remember, you produced 225 flutes. So I have it written out here for you. To get the fixed manufacturing overhead per flute, I would take the fixed manufacturing overhead in total of $3,375 and divide it by the 225 flutes produced, and that gives you then $15 per flute. When I add 50 plus 160 plus 20 plus 15, that gives me a cost per flute of $245. Now, what I want to note is how they came up with this $49,000. When you take 200 flutes times the cost per flute of $245, that is going to give you $49,000, the total cost of all flutes sold. Next, let's move on to getting a cost per flute using the variable method. When we do the variable method, we just include the variable cost of manufacturing only. So that would be the first three items: materials, labor, and variable manufacturing overhead. We do not include the $15 fixed overhead. So therefore, 50 plus 160 plus 20, and again, I don't include the 15. Using the variable costing, your cost per flute is $230. Now, it'll make more sense in a moment in step 4 when we put together the variable income statement about how the manufacturing overhead is expensed for the fixed part of it. But in this case, let's go ahead and answer question 3. How much of the fixed manufacturing overhead would remain in the ending inventory? Well, if you remember up here, we have that there are 25 units in ending inventory, and the fixed manufacturing overhead per unit is $15. So if I take 25 units in ending inventory times the fixed manufacturing overhead of $15 per unit, that gives me $375 of the fixed manufacturing overhead remains in those 25 units that are still not sold. Okay, it'll make more sense, I think, in a minute as we put the rest of it together in the variable income statement. So sales will still be the same, 125,000. That would not change from the absorption income statement. In the variable income statement, you want to put all your variable expenses together, your variable cost of goods sold and your variable S&A. You subtract out, and that is called contribution margin. Then you subtract out all your fixed expenses for manufacturing overhead and selling and administrative. Okay, so let's start with variable expenses. And I have the calculations out to the side. Remember that we sold 200 units. The income statement is based on what we sold. The cost per unit using the variable method is $230. So $230 times 200 units sold is $46,000. For the variable S&A, it does break it down in our information that the variable S&A is $10. That would be $10 per unit sold. Again, we sold 200 units. So $10 times 200 units is $2,000. Okay. I can total it over here to the side. My total variable expenses are $48,000. And then I will subtract sales minus my variable expenses to get contribution margin of $77,000. Okay, now I will subtract out my fixed expenses in total that are given right here. I have fixed manufacturing overhead of $3,375 and fixed selling and administrative of $10,000. So I'll list $3,375 and $10,000. Okay, I will total them over to the side. And then I will take contribution margin and subtract out my fixed expenses, giving me a net operating income of $63,625. Now, if you notice, the answer in part 3, we got that $375 of fixed overhead remains in our ending inventory. Notice that is the difference between our two income statements. Difference between the $64,000 for the absorption minus the $63,625 for the variable is $375. And that's because in the variable, we have recorded all of the fixed manufacturing overhead. But in the absorption, we don't record it until it's sold, and those 25 units have not been sold yet. Okay, let's go on and do exercise 6.3. We're going to calculate each year's absorption costing net income. So assume you're given the beginning units, the ending number of units for 3 different years, the variable costing net income, which you got when you did the variable costing income statement. Okay. Now we are going to do it for the absorption and compare. So I just went ahead and recopied down the beginning and ending inventory. So I recopied those here. And I also recopied down what we got for variable costing net income when we did the variable costing income statement. Okay, now what we're going to do is we're going to take the difference in inventories. In year 1, it was 160,000 for the ending, minus you had 210 for the beginning. Let's try that again. That was 160 there. Okay, so inventories between beginning and ending have gone down by 50 units. Okay, year 2, you have 200 units in the ending. You had 160 units in the beginning. So since you have 200 at the end, 160 at the beginning, you now have 40 more units in inventory than you had at the beginning. For year 3, you had 220 units at the end of the year, 200 at the beginning. So at the end of the year, you have 20 units more than you did at the beginning of the year. So instead of putting it to complete income statement, we can compare it this way. The manufacturing overhead is given here is $560 per unit. Okay, so therefore, if you have $50 units less, I will take 50 units times the manufacturing overhead per unit, which is $560. So therefore, what would happen is your absorption income statement would actually be $28,000 less because you have expensed $28,000 more in manufacturing overhead. So if I add the decrease in $28,000 plus the $290,000, which was the net income from the variable method, if you were to prepare an absorption income statement, it would come out to be $262,000. Okay, we'll do the same thing here. 40 units times the manufacturing overhead per unit is $22,000. Now, in this case, I would add them together. Oops, let's try that again. I think I took my cell there. There we go. And your net income with the absorption method would be $301,400. Okay, it would actually be more, okay, because you're taking less manufacturing overhead expense. Okay, for year 3, I will take 20 units times 560. I will add the two together. And with the absorption method, your operating income would be $271,200. So that's how we can do it without actually completing them and putting them into an income statement. There's a couple of other critical thinking questions regarding it. I've recorded the answers here, so I will let you take a look at those on your own.